All right, okay. So, it's going to be a hard act to follow. But let me have so let's do this. Now, you know what we mentioned is, this of course is cost, right? This is an estimation. This is an estimation. So what do you do if part of the way through the year, after you get some experience with this, is you say, I think this is going to be different. Maybe we can get more out of it. Yeah.
You change it.
Exactly. You do change it. I'm sorry, change what?
You change the estimate.
You do change the estimate, sure, all right.
You said, what do you do? So I said, you change
Oh, I
it.
see, okay, that was like a rhetorical, okay, good. Yeah, I thought it was like a rhetorical question.
Oh, well, that's what you do.
So,
You change
yeah,
it.
just like, you ask somebody how they are and they stop and tell you.
Yeah.
You know,
Well,
I'm good, I'm
hey, I
good
like
time
to
for this,
talk.
I just was saying hi.
I like to talk. You don't ask me questions. You don't
Okay, well, all
I will
right,
tell
well,
you how I
listen,
am.
and to kind of use that as a segue, you change it, okay? Here's the deal. Now, what you do is you get the remaining, what you do now. So in this case, when they made the new estimations, right, what they do, so in this case, what they have is now they have so it costs $10,000. At this point in time, there was $3,600 in accumulated depreciation, so this is the cost. This is the accumulated, I'm just going to write accumulated, but it's accumulated depreciation. Okay. Therefore, that difference is $6,400, and that's the book value. Okay. So now, what you do is, so this would be the revised, this would be the change in estimates. Okay, the change in estimates. It's the book value minus the revised salvage value divided by the revised remaining useful life. So, at this point in time, there's $6,400 left. That's the book value. They estimate that instead of getting $1,000, they're only going to get $400. And at this point in time, they estimate they have 4 years left. So now what the deal is, now the depreciation on the straight line rate will be $1,500. So, like you said, what they do is they take the book value, they put in if this changes, they put in the revised salvage value. If this changes, they put in the revised number of years left. Okay? Let's come back to that, because I think we can do a better job of the math there. So what happens here is the fact that the end of the useful life has arrived. And so what you've got to do is you've got to dispose of it. And there's 3 things you can do. You can discard it, you can sell it, or you can trade it in, right? Now, what happens on this, the trade-in, we won't deal with in this class, it'll come up in future classes. It's just kind of detailed, it's not terribly difficult, it's just detailed, okay? So let's deal with the discarding and the selling. And what happens here is, when you discard it, the book value is a loss. Okay? If you sell it, the amount of cash you get compared to the book value will result in either a gain or loss. So if you receive more cash than the book value, it's a gain. If you receive less cash than the book value, it's a loss. Okay? So let's start with discarding. So if you discard it, now in this particular example, the machine cost $9,000. That's the cost.
We're
Okay.
discarding first?
I'm sorry, what's that?
We're discarding first?
And we'll start with discarding, okay? And so this is what you discard. And again, all we're going to do here is we're going to the amount of the book value will show up as a loss. So in this case, and the accumulated depreciation is 9,000. The book value is 0. So if you discarded this, how much of a gain or a loss would there be?
No.
None. Okay, so what you do is, when you get rid of an asset, you remove everything from the books. So in this case, let's say you did this on June 5th, what you would do is you would debit accumulated depreciation. I'm going to abbreviate here, ACCUMDEP. You're going to debit it for the 9,000, and you're going to credit machinery for 9,000, and there's no gain or loss, okay? And you're removing both of these accounts from the books. Yeah, Addie?
And that includes the salvage value, the 9,000 accumulated depreciation?
Well, actually, the salvage value doesn't come into play here. What this says is that the salvage value is 0,
Yeah.
is what it's saying. So, what they're saying is that the book value is 0. And so what you did is you paid $9,000 for it, you got $900,000 worth of depreciation expense, you threw it away. And so, I hope I'm giving you a good answer here. So the salvage value doesn't come into play here. The salvage value would be 0, okay? And all you do in this case is remove everything from the books because it's gone
The
by.
salvage value would have had to be 0 though from like the start.
Yeah,
Otherwise,
in
it would
order,
bring up the
sure,
0
in
from
order
like-
to get down to a book value of 0, the salvage value had to be 0. And the reason is, you don't depreciate beyond the salvage value just because you'd be claiming more depreciation than you would reasonably expect, and there'd be no point in that, unless you revised it. Okay,
And you said you would debit both accumulated depreciation and machinery?
no, accumulated depreciation has a credit balance, so what you do is you remove it from the books with a debit. An asset has a debit balance, so you credit it to remove it, okay? All right, now, what happens on this thing is now, let's just save space. So now what happens is it costs 8,000, okay? And
Are we doing sell
this is
now?
a different problem, right? I'm sorry, was that you?
Are we still on discharge or are we doing sell?
Listen, by the way, could you, if you raise your hand, it'll sure help me out, because I keep getting caught,
Sorry.
no problem. Hey, listen, thank you. Now, yes, and what's your name?
Tiffany.
Tiffany.
YouTube, you'll hear me a lot.
All right, okay, all right, Tiffany, what do you got?
Sorry, are we doing this cardigan or are we doing sell now?
We're doing discard,
Still?
different problem.
Okay, fine.
Okay, all right, so discard, different problem. Okay, all right. So listen, now the accumulated depreciation, I'm going to abbreviate here, right? Is 6,000, okay? Now, the first thing you do is what you do is you bring the accumulated depreciation up to date. So in this case, it's $8,000 minus no salvage value divided by 8 years, so the annual depreciation is $1,000. In this case, this is discarded in July, okay? So that means you're going to have half a year of depreciation. So the depreciation from January 1st through the date of discard is $500. So the first thing you do is you bring depreciation expense, this is July 1st, you bring depreciation expense up to date. So you debit depreciation expense and you credit accumulated depreciation for 500. Okay, that's step 1. Then step 2 is you remove everything from the book. So in this case, on July 1st, what you have is accumulated depreciation was 6,000, so now it's 6,500. and I'm abbreviating here, and you're going to remove that from the books. And the equipment, which will be here, is 8,000. What that means is there's a 1,500 debit. If it's a debit, it'll be loss on disposal of equipment. And I'm going to abbreviate EQ for equipment. So one way of doing this is to, so in this case, you could have found the book value, 6,500, this increased by 500 from 8,000, the book value would have been 800, would have been 1,500, and you could have written that off. Or you could treat it as a plug figure. Had the plug figure been a credit, it would be a gain. Now, Tiffany, can I check with you? You doing good on this? And I hope I'm not putting you on the spot if it was meant
No, I have a deer in my headlights, so.
Yeah,
I
okay.
mean, I kind of understand, but I can't really see down there, that's why I was like, okay, because like,
Oh, so you gotta move your, okay, maybe, yeah, what,
if you could just read me the last 2 lines, that'll be good.
the last two lines say loss and disposal of asset, debit 1,500.
Okay.
Would it be helpful if you stood up?
I'm,
Okay, just trying to be helpful here,
Okay.
all right? And then you're going to credit equipment for the 8,000.
okay.
So what this is doing now is it's removing everything from the books by debiting the accumulated depreciation and crediting the asset, and then you have a plug figure. It's a $1,500 debit, that means it's a loss. If it's a $1,500 credit, it would have been a gain.
Okay,
But that's the equivalent of a plug figure that makes the debits equal to credits.
okay.
Now, to make sure you're getting a good answer here, what you can also do is just find the book value, and that is the loss. So in this case, it went from 6,000 to 6,500 when I have that additional depreciation, right? That means there's a $1,500 book value, and that $1,500 is how much of a loss you incur, it's the book value. Is it just another way of saying the same thing? Does that sound good? Yeah,
How come the debits don't include the credits as well?
they do. Maybe, again, I was just, yeah. So again, now you got, Debbie, you got $8,000 worth of debits and $8,000 worth of credits. But is that what you're referring to?
The first one is 6,500.
Was this 6,500? Okay. Okay. And yeah, the debits would always have to equal the credits. Take that as a given. All right.
Got a question over here.
Yeah.
So on July 1st, you credit accumulated depreciation and then you debit it. You do both those on July 1st.
Yeah. But hey, listen, let me give you a good answer here. So now don't forget, step one is you bring the depreciation expense current. Step two is you remove the asset from the books. Here's the step. And of course, what it does is it makes your income statement accurate, because now, this will show up as depreciation expense. This shows up on a loss and disposal of equipment. Okay, and they're both, I'll be right with you, Tiffany, they're both just more accurate. Now, a change as of maybe 2 years ago, this loss and disposal of that as equipment would have showed up under other income at the bottom of the income statement, and this would have showed up as an operational expense. That's one reason why they do it this way. A recent change makes this loss and disposal of that a depreciation expense, so now the effect is less. However, it's still more accurate if you do it this way, but this is reported as an operational issue. Tiffany?
This might be a silly question, but what do you mean by the term plug number?
Whatever it takes to, so the debits equal the credits, like was mentioned here. So in this, so in this case, a $1,500 debit makes the debits equal the credits. A
Yeah.
plug figure, and then if it's a debit, it'll be a loss and disposal of
Yeah.
assets.
I understand.
And had the plug figure been a credit, would have been a gain.
Yes.
And by the way, that plug figure will save you all kinds of work later on in the course, because it's really it's really a simple way to figure things that you would have had to,
Yeah.
okay, yeah.
And so, in this scenario, are we showing both of them, like at July 1st, depreciation expense, accumulated depreciation? Are we doing either or depending on
You
whether
do
we
both
use?
of them.
You have to use, show both.
Do both of them.
Okay. You couldn't just cut to the chase, and do the 8,000 costs and do the accumulated depreciation.
No, and the reason is, I'll be right with you, the reason you're doing it now is the fact that depreciation expense needs to be accurate, and, yeah.
You're just accounting for whatever the loss would
Yeah,
have been, even though it's
exactly.
obvious.
Well, it's not obvious, but when you go to your income statement, your depreciation expense will be accurate, and because it includes this $500. And then, down here is when you remove it. Okay. See, what it would have done is it would have overstated your loss had you not done step one. And it just would have been inaccurate to that extent. I'll be right with you. Does that make sense? Yeah, yes.
What's the part that I'm confused about is the equation, like the 8,000 minus 0/8, like how are we just supposed to pull that out and know that?
Well, they actually, that has to be a given.
Okay.
And what they tell you is the cost was 8,000. There'll be no residual, no salvage value at the
Okay,
end
that's
of
why
its
there's
useful
a zero,
life,
it's just because there's no.
divided by 8, and that has to be a given.
Okay.
And of course, it just means that there's no, at the end of its useful life, we're tossing this thing. And it's got to be a given. Yeah.
Oh, I was just gonna say, if you don't do that first step with the 500,
Hmm?
then under accumulated depreciation at the bottom, it would say 6,000, and then you would have a different amount, so it wouldn't figure in for that part. So that's why
Exactly.
it's important.
If you didn't do it, then on your income statement, if you go to depreciation expense, it would be understated by 500, and your loss would be overstated by 500. And again, 2 years ago, that would have made a big difference between, maybe 3 times wise, who knows, maybe 4. Anyway, in the very recent past, the loss and disposal of assets was reported down with other income, down the bottom, and this would have been operational. Now, because this is reported with operations, it doesn't really make much difference, but it would have in those days. I think there was somebody who's ahead of it. Anybody who was ahead of this? Oh, thank you, I thought somebody had
I think I missed, why is the 1,000 multiplied by half to equal 500?
Oh,
I missed
because
that
it's
step.
July.
Oh, okay, so it's halfway through the year.
Yeah, depreciation is normally an adjusting entry. And so if the fiscal year ends December 31st, it doesn't have to, but they said, but it does. So as of December 31st, all the depreciation had been calculated. Now, 6 months later, they dispose of this thing, and so 6 months later, there's more depreciation. Okay, yeah.
So did 6.5 years go by here then? Okay. The 6,500 was.
Yeah, it would have been 60, exactly. And by the way, it was, I changed this to 6,500 because it was after we figured the depreciation, but 6 years had gone by,
Yeah.
and now 6.5.
Okay.
Yeah, that makes sense. Okay. All right, good. Any other questions? All right. Okay, so let's do this. Now, let's go over what happens if they sell it. And again, what you do is you figure the book value, and the amount above or below the book value will be a loss or a gain. Okay. I'm going to go out this way, it'll be shorter. So in this example, okay, what we have here is, so the cost was, so they have 16,000 cost, okay? They have 12,000 accumulated depreciation. That meant the book value was 4,000. Okay? Now, what we have here then is, in this case, the accumulated depreciation, and the annual depreciation is $4,000. Okay? So, by coincidence, they're the same number. That's the annual depreciation in this particular example. Okay, and what they do is they're discarding of it March 31st. So January, February, March. So 3 months after the end of the fiscal year, they're discarding it. So 4,000 times 3/12 comes out to be $1,000, be 1/4, sure. So, step one is you bring the depreciation current. So on March 31st, depreciation expense will be debited for $1,000, and accumulated depreciation, I'm just abbreviating here, will be credited for $1,000. Now, this is still 16,000. This is now up to 13,000. So the book value is now 3,000. Does that make sense? So this is as of March 31st. Okay, does that sound good? And this is December 31st. Is everybody okay with that? Mariah, I see kind of a quizzical look. Does that make sense?
Sure. Keep going.
Now, you're just not a kind person, right?
I'll figure it out.
All right, here's the deal. And December 31st, so this is 2000 x 2, 2000 x 1, December 31. So the end of last fiscal year. Here was the cost, here was the cumulative depreciation, here's the book value, right? 3 months later, there's another $1,000 of accumulated depreciation, right? Okay, so now the depreciation expense the accumulated depreciation has increased by 1,000, and the book value went down by 1,000. Okay, now here's the deal. What happens on this thing is, if they receive 3,000 in cash, no gain or loss, because it equals the book value. If they receive $4,000 in cash, what happens? A gain. If they receive $1,000 in cash, a loss. Okay, now in this case, they got the $3,000. So when they get the $3,000 on March 31st, you're going to remove everything from the books, and you're going to have no gain or loss. So in this case, cash is debited for $3,000. Okay? Accumulated depreciation will be removed from the books by debiting it for $13,000. Machinery or equipment is the name of the asset account, and I'll write EQ just to move along here, will be credited for the $16,000, and there's no gain or loss, there's no plug figure because the debits equal the credits. Does that sound good? Now, what does it look like if they receive $2,500 in cash? Okay? Now, if they receive $2,500 in cash, what will happen is there'll be a $500 loss. Does that sound about right? Okay, Scott, is this getting a little hard to read over there at that distance?
No, I just got a tripod in the way.
Oh, got a tripod in the way, all right. Mariah?
What does the EQ stand for again?
Equipment, and just, it's an asset, the name of the asset account. And listen, and by the way, I just abbreviated to move along, but it's no benefit, it doesn't make any sense.
Okay,
All right, no, I just was going to, yeah, okay. Now, when they receive the 2,500, and I think this may be the fastest way of doing this, now what happens in this is, everything is the same down to here. Is that okay with that? But what happens is the cash will now be a debit of $2,500. I'm going to leave a blank space here. The accumulated depreciation, and I'm abbreviating here, will be debited for $13,000. And here's where I'm getting that number. The equipment, I'm sorry, it should have been a debit. Equipment, and the EQ will work this time, should be $16,000. Now, because they received $500 less than the book value, you're going to have a $500 debit. Now you can treat it as a plug figure, or you can just see that it's less, and that will be a loss on disposal of the equipment. Okay? So because it's a, the plug period's a debit, it'll be a loss. Or another way of saying the exact same thing is because it's $500 less than the book value, it's a loss. That sound good? Okay. All right, so let's do this. Why don't we start